Good afternoon. Welcome to Propelling New York Forward, a series of conversations presented by the MedTech Association, an opportunity for the biomed industry to gather around, talk of issues of interest. For those of you who are joining us for the first time, welcome. For those of you who are repeat or return viewers, welcome back. It's terrific to have you all with us. Let me just give some ground rules for those of you who are new. This series runs every Thursday at 2 o'clock. For those of you who are interested in seeing prior episodes, you can find them at the MedTech website, which is medtech.org. And the series is free, and we encourage you to search them out. We've had a real terrific group of guests over the past 15 weeks. We are coming up, hard to believe, to the end of summer. So we've got one more week of live programs in the month of August. We'll take a week off for a short summer break and then be back in the fall. Speaking of the fall, I encourage you all to spend some time at our website. We've got a full calendar of events coming up this fall, including our annual conference that will be held on the third week of October. We are like everybody else going virtual this year, and I hope it will prove to be an exciting and valuable event. So keep an eye on this real estate for what's coming up. I am also wanting to say thank you to our sponsors who make this event possible. Particularly on this series, we're particularly appreciative of Barclay Damon Law Firm, MPR Product Development, Fuse Hub, Gilroy Kernan and Gilroy, Regeneron, and Fisher Scientific. Sponsors like these help make our events possible. And if you're interested in sponsoring a MedTech event, we'd love to chat with you. And you can certainly reach out to us at a time and place that's convenient for you. That having been said, let us now turn to today's discussion. I am thrilled to welcome Eric Allyn as our guest today. Many of you know Eric. Certainly many of you know Welch, Allyn, and of its legacy. And Eric is now in the investment space, and we're going to spend some time talking about his transition, his view on investment, hopefully get some thoughts from him about where the biomed industry could and should be headed, and where we think we're going to go as we proceed through the COVID pandemic and hopefully look forward to a post-pandemic world. Eric and I will talk for probably the next 30 minutes, and then we're going to open it up to questions from those of you who are joining us. You are muted, and we won't be able to get your voice on screen, but if you run your cursor across the bottom of your screen, there is both a chat function and a Q&A. Feel free to use either one of those. I encourage you to send us the questions, and we will hopefully get to as many of them as we can. Eric, thank you very much for being here with us on this terrific summer day.
It's a delight to be here with everyone. Thanks for having me.
So Eric, as I said, I think certainly many of our members, many of the folks in our audience are well familiar with Welch Allyn, and certainly your family's role in that company. But I'm wondering if you could, perhaps for some folks who may be new to the process, talk a little bit about Welch Allyn, talk about your professional development there, and help us understand what you're doing now.
Sure, great. Well, Welch Allyn was started by my father's father, so I'm a fourth generation family member. Started in the year 1915, and it was a relatively small shop. Started in Auburn, New York, and then about 35 years and 40 years in, moved to Skaneateles Falls. The founder of the company was my great granddad, and the co-founder was Dr. Welch, Dr. Francis Welch. Sadly, Dr. Welch died within months of them founding the business. So the company Welch Allyn has been owned by the Allyn family and was owned by the Allyn family for exactly 100 years. And we'll get to what happened in a few minutes there. The company was made medical devices, medical instruments. Started with the ophthalmoscope, which looks into the eye. The otoscope looks into the ear, and essentially made devices for, well, we used to joke that we made a device for every orifice of the body at one point in time. And then we went a little bit beyond that and started making, thermometers and EKGs and monitors. And the company would not just collect this data, but then would it be able to put it together in software and interface with electronic medical records. So that gives you a general idea. Welch Allyn's market shares, it really depended on product categories. Some were very, very, very high, as in more than 90% of market share here in the United States. It was a global company. And then there are other product categories where we were small players. GE, Philips, Siemens, and a host of Chinese companies and Japanese companies competed against Welch Allyn. I joined in the 1980s. I was in college and then grad school. I went to Dartmouth College for undergrad and got my MBA at University of Virginia, the Darden School. I worked through that period as very much was kind of typical within the Allyns. We kind of started at the bottom, and so my dad had me, start essentially at the bottom of the organization, and had a very good understanding of the way the organization was run. Had a couple stints overseas with Welch Allyn, and then in the early 2000s, we actually made a big decision in the year 2006. Up until the year 2006, our family had owned, and really we were also the operators. We were the people who ran Welch Allyn through 2006. We had some kind of family issues that was not atypical of a company with 54 family members. And we decided that it would be best to change our governance model. And it was really my generation. It was me and my brothers and some cousins who rallied together and said, we still want to be family owned. And we want to be family owned for generations to come. But we knew that we could no longer be family managed. And so we changed our governance model in the year 2007 to still be family owned, but have a non-family CEO going forward. And various family members, some of them lost their jobs along the way, and some of them lost their board seats and their voting shares and things like this. But we developed a governance model that worked very, very well in the year 2006, put it in place in 2007. I stayed in the company as an employee until about the year 2010. And in the year 2010, I left being an employee and joined the board of directors. We had what I thought was a very good governance model. In a family business, you can't both be on the board and be an employee with a non-family CEO. That's just not right. Either you work for the CEO or the CEO works for you. You just can't have it both ways. So I made the decision that my skills were best utilized at the board level. I was the chairman of the board of the company through the year 2015. In the year 2015, we sold the business. As family members, we were really reluctant to do it. This is a family legacy asset, something that we're very, very proud of owning. We did not want to sell the company, but our industry had consolidated so much, Win. It's amazing to think that being a $750 million company, which is what we were at the time, wasn't nearly big enough to be successful. We'd had price erosion in our products because historically we sold to hospitals and to physician offices, and we'd sell at list prices and very good, healthy margin list prices. As hospitals consolidated and became systems, and as they acquired physician offices and clinics, you had a model where it's the parallel would be if you just make widgets and you sell them to retailers and little shops. All of a sudden, you're still a manufacturer making widgets, but now all of a sudden you're selling to Amazon and Costco and Walmart. And these companies, just like they do in the retail world, in the healthcare world, they had such power that they could squeeze our prices. We had devices that, heck, I could pull some out, but I won't. We had devices that would lose 20% of price per year. And that's really difficult. So we're simply too small. We hadn't really grown much in the $700 million range for a number of years, but really our customers had grown by factors of 10 and 20. And when your customer grows this much and you're so relatively this size, you just don't have the negotiating power. And so we decided in the year 2015, very, very reluctantly, that the Welch Allyn would be better off being owned by a larger company who would be able to maintain price, who'd be able to do the things that we couldn't as a small company. The company Hillrom acquired us in the year 2015. It's public record, so people will want to know. It was well over $2 billion that we sold the company for. It's a lot of money, I know. The good news to me, and people might say, well, geez, Eric, of course you're happy. Honest to God, our family was delighted with how Hillrom treated Welch Allyn. And in fact, here's the statistic I love to tell people. Hillrom added 110,000 square feet to our Skaneateles facility and added jobs. So this theory that, we've been trying to cut our way. When we were family owned, we were making cuts and cuts and cuts, and that's painful. We sold the right company, which is hard to do. And as a result, Hillrom and Welch Allyn have grown very, very well together. And I'm sad. I miss the place so much. When you can't believe how much. I've only been in the factory once since in the last 5 years, but it was the best thing to do for the business. I'm absolutely convinced. Had we not done that, we'd be struggling with our own existence if we were still just family owned, I believe.
So Eric, I can't help but hear, or at least think I hear, in that incredibly compelling story, some really wrenching recognitions and decisions that needed to be made along the way. I mean, when you talked early on about having this intention to keep the business as family-owned generations forward, I got to imagine that the recognition that aspiration didn't meet the future of the company could not have been an easy transition to make.
It really was painful. And, headlines in the newspaper, would reflect such utter ignorance on this topic. It killed me because they talk about how much we struggled with selling this company for $2 billion. The fact is, my family had plenty of wealth before the sale. We had no one pushing to sell this business for liquidity purposes. No one. In fact, when we start talking about what I'm doing now, the people in my family are not investors. They're not money managers. There was never an intent to extract value from this company. So yes, it was a particularly difficult decision. I do still believe, and I was the chairman of the board, so of course I'm going to say this, but I believe it was the right decision for the business. It was painful as hell for my family, though. It really was. And money is what Americans talk about a lot. I know this, but I think we all should also know, especially at a time like this with COVID and with disease and whatnot, there's a lot more to life than money. So if we could have things, if we could have history different, this consolidation that happened since, say, 2005 through 2015 in healthcare, had that not happened, Welch Allyn would still be a family-owned business.
So let's talk a little bit about what's Eric Allyn been up to since the sale, and how did you decide to do what it is that you're doing? As I said to you before we came on, it's such a beautiful day, at least for those of us in Central New York, and you're in Skaneateles. I'm envious or a little suspicious that you're not on the Finger Lakes, but it turns out that you're working full time, and I'd like to hear a little bit about that.
Sure. So in 2010, so well before the sale, 6 years before the sale of the business, I left it being an employee, and I started. I'd had some experience in the investment world. We have a family foundation. When my granddad died in 2006, he left his entire estate to our family foundation. Pre-2006 was pretty small. After my granddad died in 2006, it became a sizable foundation. And at that point in time, in 2006, I took over as chairman of the investment committee of the Allyn Foundation. So in 2006, through the foundation, I really started. I was still working at Welch, Allyn, and of course, I don't get paid for working for this foundation, and you do it as a volunteer. So, but I really cut my teeth in a pretty big way in 2006 through 2010. So when I finally left Welch Allyn as an employee in the year 2010, I had this love of the investment world. So in 2010, I set up 2 private investment funds that I still run to this day. They have nothing to do with Welch Allyn, nothing to do with the foundation. I run those independently. And then as it happened, Welch Allyn sold in the year 2015. And so I became the family, we have a couple of family members who know the investment world. And I became one of those family members, and it played a real leadership role when it comes to the proceeds, really the majority of the proceeds of the sale. I serve as the trustee for those. So today, the way I split my time is I'm on a number of boards, so that might be a third of my time. That includes Upstate Medical University. I'm on the board they have there, as well as some other family-owned businesses. I'd say I spend about a third of my time as a trustee to a series of about 100 trusts that own the majority of the proceeds of the sale. So I spend an awful lot of time on that. And then the other third of my time I really try to spend with family members as they transition. Again, people in my family were not raised to read the Wall Street Journal every day, to understand the implications of the 10-year Treasury hitting 0.68% and what that means being a risk-free return and what that really means in portfolio management. Things like this just didn't really translate to most people in my family. A typical brother or cousin or niece or nephew of mine could tell you about a stethoscope. They could tell you about an ophthalmoscope. They could tell you about EMRs, electronic medical records. But generally speaking, we didn't have that same level of sophistication around money. And in the year 2010, when I left Welch Allyn, I got, I really started to do that. And after the sale in 2015, I've really played a leadership role in that area. So to say what I'm doing today, most of my time is doing some board work, but most of it's trust and investment management.
So let's talk a little bit about that investment piece. Can you give me a sense? Do you have a governing philosophy? What is it that animates you and interests you and you find promising in your work in investments?
Okay, so the biggest one really is understanding the intent of the investment vehicle. So I'll give you an example. The Allyn Family Foundation is a foundation my family has. It has $90 million of assets. You have to start with what's the intent of these assets. In this case, our foundation makes distributions of about 5% every year. So rule number one is, Eric, you got to make 5% at least. And like I said, in the year when a risk-free rate was 3.5% or 4 or 4.5%, anyone could make 5%. I mean, really, anyone could. Today, the risk-free rate is 0.6. And that means you have to take a lot more risk in the rest of your portfolio. So kind of translating what the intent of an entity is, what the intent of the investment is, to then putting in place the right investments to satisfy that intent is where I spend most of my time. So the Allyn Foundation is one example. I'll give you another example of the foundation. When, as you know, the Allyn Foundation's building this building in downtown Syracuse. It's going to be a bunch of non-for-profit entities and businesses within it, as well as some offices and some mixed income housing. We're very, very proud of that. It's about a $24 million project. And we were able to fund that, to finance that by borrowing against our endowment, our investments. So we can borrow against those to pay for the building. Now, of course, we have to pay it back, but essentially we're able to collateralize our current investments with it. So there's an awful lot of work that goes into that, kind of navigating those things. And that's strictly for the foundation. I also mentioned I oversee I set up some of these little funds myself. One fund was all about income and the other one was all about growth. And again, you understand the intention of an investment vehicle, then you can make the right investments. And then the last one I oversee as trustee is again, the majority of the proceeds of the sale of Welch Allyn. And in that case, I'm a trustee, so I'm a fiduciary, and I'm really legally responsible for these. And in that trust world, there's a lot of fear that people get sued and whatnot. We have family members as beneficiaries, but we also have charitable organizations as beneficiaries. And I do know some cases where the Attorney General has sued a trustee because a beneficiary would eventually be a charity, and a trustee made an investment decision that might have been irresponsible. So really understanding the intent of the vehicle, the funds, is the most important. And typically what we do then is we put together what we call an IPS, an investment policy statement. And that IPS, everyone has to sign off on. And it might be, hey, we're going to grow radically, or hey, we don't want to take much risk. We just want a 5% return. And once those things are kind of agreed on, then kind of the fun begins. Then you can say, all right, okay, if this is what we want, this is what our asset allocation should look like. This is how much we should have in stocks and bonds and alternatives. This is how much, if you're a growth fund, you look to venture capital. If you're an income fund and you have to pay out 5%, you're not going to look to venture capital. So different pools of money or pots of money typically have different intentions, and understanding that is and then putting those into place is really important. How about I give you a good practical example? So one of these funds is income oriented, and there's these things called, and that income fund is just going to pay out 5% a year. The fund itself won't grow, but it's just going to pay out 5% every year. And so how can I do that? One way is kind of not to get too greedy and put a limit on how much upside I want in return. But in return for that, I'm going to get a guarantee of a certain return that won't go below a certain downside. So they have these things called structured notes. And you get to invest a big hunk of money in a structured note, but in a structured note, I can invest in an index or a single stock. I could invest in Apple. So imagine back when Apple was $200 a share. There was a structured note that said, okay, if you buy this note at $200 a share, you're going to get a 10% return after 12 months. If Apple stock goes up and doubles, which it did, by the way, if it doubles, you're still only getting 10%. However, if Apple stock goes down and loses 30%, you still get 10%. So you give up upside for protection on the downside. For a foundation or for an income fund, that's something that's really exciting. I've come to understand how some of those things work and the options that underlie those instruments. And so that's where I'm spending my time. I will tell you though, the toughest part of it all is starting with the discussion with whatever the intention of that vehicle is. What do you want? How much risk do you want? What's your time horizon? my dad's investment goals are very different and should be very different from my kids' investment goals. And recognizing that is really important.
Let's talk a little bit, if you don't mind, about kind of the other side of the equation. Certainly many of, I dare say probably all of our members, right, in one way or another, are looking for investors, are looking for capital opportunities, particularly for our members who are entrepreneurs or who are in the startup space, right? All money seems fungible. Certainly all money seems attractive, and yet it's difficult to know where to start. I mean, you present a very clear story, Eric, but I can't help but imagine that there's an awful lot of complexity that has gone into your understanding of that. What would you say to the startup out there in the device or the pharmaceutical space that is hungry for, that needs investment? What are the options out there? Where do you begin the process of looking? And I got to imagine your email inbox is absolutely overflowing with folks who would like you to invest some Allyn Foundation money into their venture. How do you separate the wheat from the chaff?
So that's such a good question. Particularly when it comes to startups, Welch Allyn was anything but a startup. It was a 100-year-old company, right? So I claim no expertise when it comes to startups. And I think when it comes to managing money, managing investments, taking ego out of it is everything, because there's so many people with huge egos in the investment world. And one of the key things that we did early on was say, hey, these are the things we can understand, and these are the things we don't understand. And early stage investing was one of those. So, I got hit up plenty in the late 1990s and the early 2000s. And I remember having some discussions with some other folks, including my dad, and the idea of, we do want to invest in upstate New York companies in particular. And we love healthcare, but we have to know what we don't know. And we don't know how to be a good venture capitalist. Why don't we get involved? Why don't we get some other people together? And the end result of all that was actually Armory Square Ventures, run by Somac, who I hope everyone out there in the early stage companies does know Somac. He does a tremendous job. Center State CEO really took the lead in recruiting, in prioritizing, and then driving the process, which resulted in the formation of Armory Square Ventures. And my family is one of the investors in it. And actually, I serve unpaid, but I serve as an advisor to Armory Square Ventures. But the important part of that win is knowing what you know and knowing what you don't know. I believe that startups take to really add value to a startup, you have to live in this universe. To kick the tire on 3 times a year or 4 times a year, which is what I would do, the value add would be minimal. And people might say, yeah, but gee, your name would really help. Yeah, okay. And the money would really help. Yeah, but what you really need is some help. You need capital, but you need people who have a Rolodex. You need people who have access to not just that initial capital, but your follow-on round, your round 2, your round 3, your round 4. The people at Armory Square Ventures were one of the first investors in ACV auctions. ACV auctions started with 6 people. Somac was involved in hiring the CEO of ACV auctions. ACV auctions today employs, I think, 1,000 people. They're based in Buffalo, and they do a tremendous job. And that's because Somac and his colleagues really understood the Rolodex, had the Rolodex, and understood the network of people in the next stage of venture capital, the next stage after that, next stage after that. Armory Square Ventures got involved in the first round of funding and actually participated in the second round of funding. The third round of funding was $300 million. That's well beyond what Armory Square Ventures' whole portfolio is. So having a Rolodex that could say, we could pull in Bessemer Ventures, which is one of the partners they brought in early on, or some of these other very, very large pockets. That's what venture capitalists do as well. And then, of course, they know people who have run startups before. I know the people at Welch Allyn really well, and Welch Allyn was the opposite of a startup. Again, we had huge market share. And by the way, that has its own challenges. Sometimes the startup world is a lot more fun and exciting than when you have 95% market share for the ophthalmoscope in the United States. How do you retain that? Those are very different cultures. And so kind of understanding that, that's one of the things that that we had to do, particularly when it comes to startups. So when in the rounds after a startup, the kind of growth capital, the growth equity stage, let's say a company has revenues, let's say they might even be EBITDA positive, but they have something that's scalable, and with more capital, they can now begin to scale and produce much higher levels of return. There are people who are experts in those areas as well. So, as the person in my family who gets most involved in managing money, it's kind of knowing where to go to, not trying to do it yourself. We do very few direct deals. I'm just not, I'm not willing to take the risk myself. I'm just not. It would be irresponsible to do it for the foundation. It just would. It'd be irresponsible for me to do it as a trustee for a series of trusts where the beneficiaries are, in some cases, people haven't even been born yet. So having and working well with people in the venture capital world, like SOMAC, people in the private equity world, and knowing that there are experts out there, and then knowing the questions to ask them, and how to develop a relationship with these providers. This is where I spend the majority of my time. We do have something for the trust. We have someone called an OCIO, which is an outside chief investment officer. So we use an OCIO relationship or model with BlackRock for some of these investments. And we have a similar type model with JP Morgan with some others. And, it gets very detailed, very granular, making sure that I understand that well enough and can help participate in the decision-making process, and then put my signature on it, and then be able to speak to a foundation board or all these trust beneficiaries. That's where I spend the majority of my time.
So I have to imagine, as I'm listening to you, that there must be a certain amount of confidence or certainty that comes from being the CEO of a company that has the 90% share in the otoscope market.
Yeah.
How did Eric Allyn figure out how not to get too swell-headed when he decided to make the move into an area that he hadn't worked in before? Help me operationalize, Eric. I mean, do you have family members that wait for you at the door every night to tell you that you really don't know what you're talking about, or how do you begin to assess those things that you think you need some expertise from others about?
My folks really did always encourage me back within Welch Allyn, but they also said, again, you start at the bottom, and so that philosophy, when I left Welch Allyn in 2010, you have to start by knowing the lingo, by being humble, by acknowledging what you don't know, and just like anything else, I mean, different industries have their own vernacular. They have their own lingo, and lingo can intimidate people. Certainly in the investment world, oh my God, the lingo is, you could write books on it. In fact, people do. So I think being humble is a real big part of it. And, I also I've always thought that, hey, if I'm not going to be the one to run Welch Allyn, in the year 2006, we made that decision. We're no longer going to have family members do this. I did look kind of down the road and say, well, gee, where else then? How else could I serve my family if not running this company? And so it did kind of become pretty self-evident pretty quickly. And then let's admit it, the financial crisis in 2008 and 9, money wasn't returning. It's similar today. Bank accounts and money market accounts were returning almost nothing. And I did have, I had enough business school training, and I'd have enough experience to say, gee, I could provide a 5% return to people rather than being in a money market account and getting 0.25% or something. And so based on that, I was able to, and I started with family members. And by the way, I don't run any of these things publicly, so I don't take investors. The only people who I do anything with at all are my family members. And I think honestly, they look at me and say, hey, Eric, thanks, because I don't understand any of this stuff. Again, remember, I've got a brother, Mark, who's a school teacher in Boston, and Mark's been a great fourth grade teacher. And he has no desire to get into the intricacies of a hedge fund vehicle. You even mentioned that to Mark, and the eyes would roll over, or you talk about real estate investment trusts, or just talk about asset allocations and small cap and large cap, and you can turn people off really quickly there. And in the case of my family, I think they have a real genuine appreciation that says, okay, Eric, we appreciate you doing this for us. And then, I do, for what it's worth, I do try to educate family members. These little funds that I run, I send out every month a different email. I just sent one out about put options, selling put options. And I'll probably have so in this case, I maybe have about 30 family members in this particular fund. Of those 30, maybe 4 or 5 of them will read it through, but that's making some progress. When I will tell you that the toughest thing I do struggle with is for family members, they're not going to want to back when we owned Welch Allyn, we would have family meetings, and we'd have a family meeting. We'd be able to bring someone from the company, or you bring a patient in, or you bring someone who may have been blind or deaf, and because of that, they developed an instrument that Welch Allyn's now part of. Or we used to make defibrillators. You'd have someone who was saved by a defibrillator. I mean, the things like this that would just really rally people and make them feel good about Welch Allyn. I gotta tell you, there's something really crass now about getting people around to say, hey, here's a sheet of paper, here's your wealth. There's something that, especially that next generation, that's a turnoff. That's a total turnoff. They don't want to be known as a trust fund kid. That's a nightmare label for them to have. So instead, the idea of having impact investing, the idea of what our foundation does, I can pull people in if we're talking about ESG investing. And for those who don't know, ESG is just environmental and social and governance. It's investing in companies that are not terrible for the environment or have awful governance systems, like maybe Facebook. I don't know. That's probably a good example. So ESG investing or impact investing, investing in communities where we need more investing in women-owned enterprises. These are areas that I think I can gather family members around and get them more excited and engaged. So like I said at the very beginning, it's all about knowing what the intent of the funds is. And for some of these, if they are family members who are involved, and they don't want to know anything, and they kind of give me free latitude, that's great. If they kind of are younger and might want to learn a little bit, then we can have discussions and talk about, well, gee, here's how you can use some of that wealth for good. And those are great discussions.
Let me turn to a question that we've gotten from one of our viewers who asks, with the COVID disruption, clinical diagnosis all over the world has a new opportunity for growth.
Yeah.
Kind of where, putting your hat back on from your days at Welch Allyn, give us a sense, Eric, if you can, from your perspective, where do you think the leading trends are in the device and biomed world?
I think sometimes I become unpopular when I answer this because, I'll remind people that it's $700 million of revenue. I thought Welch Allyn was too small. Welch Allyn was too small to grow and to thrive. So I think there's plenty of room for innovation, for startups, for building a company up to a certain size. But I also am a real believer that scale matters. And here I'm not talking about scale in terms of how many of something you get, but scale relative to the size of your customer. So I am a believer in the medical device space. Absolutely. I'm a real fan of it. I'm a real investor in it. I continue to own a lot of Hillrom shares, by the way. And there's an index of medical device companies called the IHI index. I believe that's the name of it. Investor in the IHI. But and I also very much believe in startup companies satisfying some of those. There's the company Rheonics down in Ithaca. Rheonics, I've actually been an investor in Rheonics since 2011, I think. And Rheonics has a spectacular technology. I mean, just some real world-class stuff. And I think this particular COVID experience we're going through has certainly given them more legs. But when you go out there and look in their space, there are companies that are 10,000 times their size, and so ultimately, I believe that these, it's just like the pharmaceutical companies often buy these little biotechs along the way. I believe that the Abbotts of the world and some of these other great medical device companies will end up buying some of these other more local startups. And there was a point in time where I used to think that'd be a bad thing. And I can tell you from the Welch Allyn and Hillrom experiences, it's not a bad thing for the business. Again, Hillrom has built Welch Allyn. So in terms of the question, I'm a believer in these technologies. I believe that they should be developed. And I believe the toughest decision at all might not be for another generation for these companies. But there's a point at which the prospect of not owning it yourself, but the business being able to survive better if it's owned by, again, Illumina. I don't know, take your medical device company, would be better.
So apropos of that, another one of our viewers asks, as someone who's lived a company throughout his existence in upstate New York, can upstate New York continue to survive as a home for companies in the biomed space, or is our future given over to being acquired by larger corporations headquartered elsewhere?
No, I do think I'm a real believer in upstate New York. Part of it's because of our university base, and I really think it does start there. But we also have pots of capital in this area. I mean, and I'm not talking about just my own families. I think of the people in Rochester. There's a lot of capital in Rochester. So I am a believer in upstate New York. I don't think that we'll all end up being, this will be a ghost town state. And that's because, again, universities plus capital. I do know that from time to time, but people complain about various things on the state. I think New York's got a heck of a lot more going for it than it has going against it. Much more going for it than it does going against it.
And we've got time for one last question, so I'm going to tee up an easy one for you, Eric, that someone writes in, and they say, what is the single most important insight that you've found that has helped you transition from your prior career to your current one?
Starting from the bottom and just never thinking you're the smartest person in the room, because you never are. You know, I've worked with people who think they're the smartest people in the room, and first of all, they're obnoxious, but more importantly, learning doesn't happen that way. And you know, starting low, never being afraid to get your hands dirty, even if you have a big picture, a vision that's way out here, you got to understand the details down here. And then the other rule of thumb I always use, and I use this in all my investment, I won't make any investment until I can explain it. And I have to be able to explain it to people who don't know the investment world. I have to explain it to, let's talk about my brother Mark, the school teacher. Like, I have to explain it to Mark and say, hey, Mark, this is why. In the year 2011, I bought a lot of the shares of the company called Tesla at $35 a share. And today it's $1,500 a share. It's done really, really well. And before I pulled the trigger on that, I had to explain to, in that case, actually in that case it's more my dad, explain to my dad, but I had to be able to build an argument to someone who's not in the investment world, why something like this makes sense. So I don't know. I think, again, it's a combination of starting low, and yeah, you want to have a vision. And if you ever need to double check something, make sure you can explain it to someone who doesn't know anything about the topic.
Well, on that note, Eric, I'm afraid we've run out of time. This has been a terrific discussion. I know our audience has been engaged. This has really been wonderful. So I want to thank you.
My pleasure.
And thank you and your family for generations of commitment to upstate New York, to the medical device field, and best wishes as you continue on. I know you've got some other meetings this afternoon, but boy, you know, summers are short in upstate New York. I hope you can find your way out to the lake before too terribly late. So on that note, we'll let you go. To our audience, thank you for being with us. Again, next week we'll be talking with Ben Zombek at BZ Design about integrating the product the user experience into the product development space. And again, you can find all of our previous episodes at medtech.org. With that, again, Eric, thank you, and thanks to all. We'll see you next Thursday.
Thanks, folks. Bye-bye.